Welcome to the first session of your book 4 for FRM Part 1, wherein we'll be discussing about the risk and return of a portfolio. We'll be talking about R, we'll be talking about uh, excess shortfall, we'll be talking about GARSH, we'll talk about EWMA. So well, let us start with something basic, which you have already done uh, in your book, either in your book 1 or in your book 4. We'll be talking about an important concept of risk and return. Friends, whenever we talk about any investments, the two important parameters that defines or that determines how whether it is feasible for me to invest in a particular security or in a particular portfolio, the two important parameters are the risk and return. And in order to calculate the risk, as you may have already dealt with this particular terminology, the risk and return, and there is a trade-off that always happens between risk and return. And we also are aware of higher the risk, higher the returns, and lower the risk, lower is the returns. So let us firstly understand how do we determine returns and how do we determine risk of an investment product, or for that matter of a particular security, of a particular equity product. How do we determine their risk and return? And then how, if I have to combine few securities, combine few investment products, and develop a portfolio, how can I determine the risk and return of that portfolio? And if I also want to understand, I want to deep dive and understand what is the value at risk for that portfolio. We'll be walking through in this next 2 hours. We'll be walking through these important concepts. So let me start with a very simple, basic 5 minutes discussion on what is risk and return all about. We are aware that whenever we have to measure, so starting with the measuring of your risk. So how do you measure your risk, friends? You measure your risk, sorry, I'm so sorry. How do you measure your returns? Let us start with firstly measuring the returns. So if I have to measure the returns, there are two ways in which the returns are measured. As you are aware that there is something called as ex ante and there is something called as ex post, right? We have been discussing this in our book 3 and to a certain extent in book 1 also. So ex ante is something wherein we are anticipating. And for anticipating the returns, predict the returns of future, we need something called as exposed. And for an exposed returns, we generally go for something called as HPR, that is the holding period return. And with the holding period return, we also calculate the annualized return, and then there is something called as CAGR, compounded annual growth in returns. So these are the parameters, or these are the means through which I measure my returns, provided I have the historical data with me, right? So if I know the performance, or if I know the share prices for the last few years, on that basis, I can determine their HPR, their AR, and their CAGR. And with your HPR, the holding period return, as you all are aware, that the very basic formula is that we use is PT minus PT minus 1 upon PT minus 1. And if there is any intermittent cash flows that happen in the form of interest or dividend, that is also added to your total return. So this becomes the form of your capital appreciation. Right, friends? And this becomes your intermittent cash flows, or it is something called as dividend, which may be paid in between or during the holding period. So this is the total return which you have got. This is a total inflow to the investment which you have made. So capital appreciation and dividend, if I have to find out my holding period return, I take the price at the time T, that is at the end of the period, and the price at time beginning of the period, that is beginning of my investment, and I try to determine my HPR, my holding period return, right? And if I have to get it in percentage form, I multiply it with 100, right? And then on this basis, I also calculate my AR, that is your annualized return, with the help of HPR. If I know what my HPR is, and if the HPR is, let's say, for a period of 3 years, 5 years, I just divide my HPR with the number of years to calculate the annualized returns. So this is basically required to determine your ex post return. Ex post means something which has already been, it has already been received by us, or which is historical, through historical data. When I calculate the holding period return, it is called as ex post return. And this ex post returns help me to determine my ex ante returns, right? And that is called as your expected returns. Right, friends? Expected returns, and we calculate our expected returns with the help of something called as mean, for that matter, average. What is the mean returns, or what is the average returns? Taking into account the HPR returns, taking into account the HPR, I calculate the anticipated returns, or what can be my expected returns for the days to come. That can be done with the help of your exposed returns. That is what how we measure the returns, and we are all aware to calculate the mean. A simple way of calculating your mean, or let's say if you want to find out your expected return on ith security, then what I do is I do a summation of all the i's from one period to n periods, right? And divided the number of years to get my expected return. Or let's say if there is any probability given to me, then for expected return of RI, that is the return on my ith security, I do a summation of all my PIs, that is my probabilities, and my returns of that corresponding to that probability, whatever is the return I get on my I security, where I ranges from I raised to 1, I determine my returns. Right? I get my expected returns, and this is something which we are all aware of. Right? I will be taking some example also, so that you have a clear idea as to how do we calculate the risk and the return. So this is how to measure a return. Now, friends, in the same way, the same way, I can also determine my risk, right? So let me walk you through the returns. Right. Now let's understand how do we measure our risk. The way in which the returns risk can be measured. It's very simple. We generally take into account the standard deviation, or the variance, or the standard deviation of my returns, standard deviation of my returns, to calculate the risk. Now, friends, we all are aware when we talk about total risk, it comprises of two important concepts, or two important components. One is systematic risk, and the other one is unsystematic risk. Right? So when you talk about the systematic risk, this is something which is undiversifiable. That means this is something which is there in the system, right? Which can have an impact on all investment avenues, right? But the intensity with which the impact will vary from security to security, from investment product to investment product. But it will have some impact, because that risk is there in the system. That is the reason we call it as systematic risk, and that is something which is undiversifiable. Another component, that is the unsystematic risk, which is diversifiable. When I say that my risk is diversifiable, that means I can mitigate this risk. There can be risk mitigation through diversification. Risk mitigation can happen through diversification. Right? That is what we all have studied earlier. Okay, so unsystematic risk, which is specific, business specific, we call it as business risk, right? So this is something which I can reduce it, I can mitigate it through diversification. But systematic risk is something which is like a market risk, like interest rate risk, inflation risk. Definitely, it will impact every economy, it will impact every sector, it will impact every industry. But the impact will vary from industry to industry, from sector to sector, and the intensity will be different. But friends, one thing we all are aware that when we talk about total risk, the systematic and unsystematic risk, the systematic risk is something which is undiversifiable, and unsystematic risk is something which is diversifiable. And with the help of diversification, we can mitigate the unsystematic risk. This is what we have already learned. Now let us go ahead and understand something called as a portfolio, right? Now, friends, we all are interested in having a portfolio of securities. Why? Because we have already discussed that with diversification, I can reduce my risk, right? So, what I want to do is I will develop a portfolio. I will, let's say, I will include those securities in my portfolio. Let's say I have 4 securities, A, B, C, and D. That is where I am trying to measure their individual risk, their individual returns. So what I'll do is, firstly, the first step towards developing a portfolio is I am going to determine their risk, right? Their risk and their returns, right? So it will be done for all your securities, risk and return, risk and return, risk and return is what I am going to determine for each of the securities. And then there is something called as correlation. I need to have a correlation because we know that when there are different securities available in the market, there is some sort of correlation that prevails between the securities or between the asset classes. The way we say that the gold and the crude oil prices have a correlation with the foreign exchange rates. The interest rates have a correlation with the inflation rate. Right. So if there can be one sector, one industry which can have a correlation, or we can say that the power industry has a correlation with cement industry, or cement industry has a correlation with infra. So there can be some relationship between the securities, and that is what is very, very important to determine a portfolio. I am trying to create a portfolio, and as you will all are aware of this thing, that never put all your eggs in one basket, right? We are aware of this particular concept, which says that never put all your eggs in one basket. Why do we say that? Because if anything goes wrong, because if, let's say, the basket falls down from my hand, what will happen is that all the eggs will break, right? So that's the reason we say that never put all your eggs in one basket. And it is always advisable as an investor that you try to have a diversification and put your eggs in different baskets, so that even if one basket falls down, let's say there are 3 baskets in your hand, and one basket, even if it falls down, at least these 2 baskets are safeguarded or they are protected. The same concept applies to your portfolio. In a portfolio, when we want to have a diversification, the primary objective is that I need to reduce my risk, right? I want to reduce the risk of my portfolio, and for that, what I do is I diversify, right? And I need to, for diversification, I need to understand the type of correlation that prevails between securities, right? So let's say if I have 4 securities, I need to understand what is the correlation between A and B, B and C, C and D, A and C, and B and D, or there can be multiple ways in which I can understand the correlation between 2 of the securities in the portfolio. And what is important is there is the great economist who has, his name is Henry Markowitz, which he has come up with something called as an efficient frontier or an efficient growth portfolio, right? So in his theory, or in his the theory which the Markowitz portfolio optimization theory, it clearly defines that the correlation, if we have to diversify, the correlation between two securities, we all are aware that the correlation will be between +1 and -1, right? So there can be a perfect positive correlation between the securities, or there can be a negative, perfect negative correlation between the securities. But as per Henry Markowitz, clearly says that the negative correlation between two securities is always feasible with a positive, a perfect positive correlation. Why so? Because if, as I said earlier, if one security, let's say if I have A and B security, two securities in my portfolio, and they are negatively correlated, if A is moving ahead and if B is moving downwards, since there is a negative correlation between the two, at least I am convinced and I am sure that if A doesn't perform, B will perform. Or when B performs, A, and if let's say A is not performing, B will perform. Right? And that is the reason we generally what we do is for diversification purpose, we try to add more and more securities or more and more asset classes in our portfolio wherein there is a negative correlation that remains. Right? That is how we understand about how to develop a portfolio. So when I have to develop a portfolio, the two important concepts that I need to understand is one is diversification and the next one is correlation. Right? Diversification will help you to reduce your risk. Correlation will help you to understand if there is a negative correlation between the securities, I can choose these two securities and I can add them in my portfolio. Right? So that is how we determine our portfolio risk and return. Now, friends, as we all are aware, that when we have to measure the risk and we calculate the standard deviation, there are different formulas that are used. So the standard deviation of a security, as we all are aware, is given as summation of all your xi minus your xr bar, that is xi bar, that is your expected return, raised to 2 upon n minus 1. Why I use n minus 1 is because I am not dealing with the entire population, but I am only taking out a sample. It is not feasible, it is not possible for me to have the entire population, to study the entire population, right? So I choose 1 year data, 2 year data, or a 5 year data, and it is out of a population, entire population, I choose a random sample, and on that basis, I determine my variance or my standard deviation, right, friends? So when I do this, so this is the formula we generally use. If let's say we are given with something called as PI, then the formula goes this way. What we do is we do the summation of all the I from 1 to n, take into account the probabilities of all the securities, and then xi minus the variance between the two raised to square. So this is how we measure the right. This is something which you all are aware of, and I hope that this is something which which you very well have studied, right? So now let's move ahead and understand the risk and return of a portfolio. I will walk you through an example also so that your concepts become more clear. So this is the learning objective of today's lecture. We are going to talk about R, we are going to talk about ES and overhead risk. We are going to determine all this. So to start with, we'll talk about an efficient fronting. So this is something which I have already said. So the term risk is defined as the degree of uncertainty about your future net return. So friends, we all are aware that let's say we are talking about ABC security. Let's say I have ABC shares. Today, the spot rate of this shares is rupees 100. Right? We are very well aware that the possibility, let's say after 1 month, period, the ABC shares may either go to 150 per share, and or it may go to 50 per share. If it goes to 150 per share, definitely I will be a happy person, right? Because that is something which is expected. So whenever we buy a particular security, what is our anticipation or what is the expectation that I should be able, the share prices should go move ahead, should rise, so that I can make good profits. But the concern is, what if the share prices fall down to 50, then definitely I am sad. That is where my risk lies, right? So risk is something, friends, when we talk about risk, it is a degree of uncertainty about your future net return. So uncertainty is there on both the sides, right? But I am more concerned about this fall rather than this rise, right? That is what is risk all about. Credit risk relates to potential long-term inability of a counterpart to meet its obligation. We will be, studying credit risk in length and in breadth in subsequent sessions. But for the time being, we should understand that whenever there is any default that happens from a counterparty who do not meet their obligations, who do not fulfill their share of commitment, we are faced with credit risk. Operational risk is something which is, because of some human error or internal or external factors, if there is any delay or if there is any payments or settlement transactions are affected, we call them as operational risk. And liquidity risk is something where, when we don't have, if I'm not able to, I don't have organized market to sell off my assets and convert it into cash. And because of some stressful negative cash flow, some, in the short run, we call it as liquidity risk. And market risk, as we all are aware, what is market risk? When we talk about any equity prices or when we talk about interest rates, foreign currency, or bond prices or commodity prices, any asset class or any security which has volatility, right? And where we are uncertain about how prices are going to move, in what direction, we call it as market risk, right, friends? So market risk estimates the uncertainty about your future earnings due to changes in the market conditions. We are well aware that there is a lot of volatility that prevails in the markets. The standard deviation of the variable measures the degree of risk inherent in the variable. So our variable is, we are talking about the share prices. So if I have to say what are the standard deviation, if I want to measure the risk, the degree of risk inherent, that is which is there in that variable or in that share prices, in the security prices or the bond prices for that matter, standard deviation is what is the measure, and that is what we have already discussed in the previous slides, right? So yes, market standard deviation is what is required. So if I say the standard deviation of returns from the assets owned by you is 50%, and the standard deviation of return from asset I owns is 0%, we can say that risk of my asset is 0, right? So the deviation. So if when we are going to talk about the normal distribution, then there also we'll be talking about something called as deviation. So let's say this is my mu, right? So the deviation can be both sides. It can be positive, it can be negative, but I am more concerned with this side of the fall, right, of the movement. So if I have to talk about I own a riskless asset as standard deviation of returns of my assets is 0, then there can be another person who can say that because the standard deviation is at a higher level, at a 50% level, I'll say yes, my assets are very, very risky. So here definitely I am a happy person, and here I am very sad, right? So need variance, this is what I have already discussed with you. So when the traditional way is, in order to calculate your returns, we use mean, right? Average, we call it as, and when I have to measure the risk, we generally use standard deviation, and then the return distribution, that is elliptical distribution. Most commonly, we use the norm distribution. Right, so this is what is generally used, and even the Markowitz portfolio optimization theory talks about normal distribution. It says that if there is a mu, that is your returns, my deviations can happen. So the normal distribution, it is also called as Gaussian normal distribution. The normal distribution is defined by the first two moments, that is mean and variance. So this is what we have to always remember, friends. Now throughout next uh, half hour session, 1.5 hour, we are only going to talk about the mean and variance. So variance is nothing but the square of your standard deviation square. So we symbolize it in this way. So mean, this is your mu is nothing but your mean. Okay, so mu is your mean and variance standard deviation square is your variance, right? And the probability density function of a normally distributed variable, the formula is given to you as 1 upon square root of 2 pi standard deviation or square, that is your variance, upon exponential of your minus x minus mu, that is nothing but your standard deviation again, the whole square upon 2 into standard deviation square, that is your variance. The probability of the value lying between A and B is given as, this is something which we have already done in our book 2. So the variance of a normally distributed variable is represented as standard deviation square. If the two variables are individually normally distributed, then the linear combination of both is also normally distributed. So that is what is the assumption, that if there are two securities, right? If A security and B security, I am developing a portfolio of securities, and if the A has a normal distribution, B also individually have a normal distribution, then when I create a portfolio of AB, definitely it will also have a normal distribution. That is the assumption that is like. And then let us take an example of two variables x1 and x2, which are normally distributed. When I say it is normally distributed, that means it has a mu and a variance, right? So then x is equal to a into x1 plus b into x1, where a and b are nothing but your weights of your and x2 in your portfolio, right? How much? So if I'm saying I have 100 rupees in hand, right? 100 rupees, then how much I am going to put into A and how much I'm going to put it into B. That is what is the weights of these two securities, right? So A and B, these are the weights, and in our example, we are using x1 and x2, right? So if I have a portfolio of x1 and x2, if I have put uh, 8% of money in x1, then A1 minus A or B will be the proportion of money which I'm going to put it in x2. So generally, the properties of normal distribution are that we all are aware that the probability of outcomes further above and below the mean gets smaller and smaller, but do not go to zero. Friends, this is something which we have to always remember. It is extend to infinity. I had earlier also I had drawn this. I am drawing it n number of times. So if I am talking about my normal distribution, please find my drawing. So this is the center point, and this is your mean. That is nothing but your mean. So it is nothing but your mean, median, and mode, right? So this is the point of your mean. And then we said that the movement happens on the side. But friends, you will see that there is not, it never converges or it never goes to zero, right? It is towards infinity. So it will never go to zero. That is what is the feature of a normal distribution. It is a CDF with total area under the curve that is equal to 1. So your total area, the shaded region which I am, I am doing it on the screen. So the entire CDF, right, your cumulative density function will be equal to 1, right? So this is what is CDF. What is it is the properties of a normal distribution. The confidence interval. So the confidence interval is a range of values around the expected outcome within which we expect the actual outcome to lie. That is, if I am using these as my percentiles, right? So 5%, 1%, 2%, 3%, 5%. So if I am using 5% percentiles, right, and I want to, that is called as your confidence intervals, that what is the range of values around the expected outcome within which we expect the actual outcome to lie during specified percentage of time. So if let's say my confidence level, that is 1 minus a, where alpha, or alpha is also called as your level of significance, right? So if let's say this is your, these are your confidence intervals, right? So these are your confidence intervals. So it is one standard deviation. So it is positive one standard deviation, negative standard deviation, one standard deviation. It is two standard deviation, negative two standard deviations. It is three standard deviations. So it will go on and on, right? So it will keep on increasing as we go towards the right and left. So it is three standard deviations. So when I am trying to find out, so this is, let's say this is the area till which I want to find out, this is the area for which I want to find out, then I will use the confidence interval of 2%, right? So 68% of your CDF will be between 1 and plus 1 plus and minus 1 standard deviation. 90% of your confidence level will be in between plus and minus 1.65 standard deviations. 95%, right, is between 1.96 plus or minus 1.96 standard deviations, and 99%, which is very close to 3 standard deviations, is 2.58 plus or minus 2.58 standard deviation. So that is what is the normal distribution, how the distribution is done in a normal curve. So summation property says that, the property states that assuming there is a collection of normal distribution, the sum of means of all the independent normal distributions form a normal distribution. That is what we have already said in the previous slide, where I said that if I have n number of securities, and if all the securities are normally distributed, their summation will also give me a normal distribution, right? And the sum of the variances of all the independent normal distributions will also form a normal distribution. That is what is the summation property all about, right? So here, if I am talking about, here I'm talking about 1% standard, one standard deviation, right? So this is positive. So 1%, that this is a light blue area. It is 68% of your data is between 1 plus and minus 1 standard deviation, right? And if 95% of the data, so if I'll say 95%, so it is over here, right? So 95% of the data is, we already said, it is 1.96, right? So 1.96 standard deviation is plus or minus will be your 95% of your data, and 99.7 percent, right? So here we are talking about it will be more than that. So minus 2.58 standard deviations. That is how we try to calculate the standard deviation, or you can say the given a confidence level, I can calculate my variance. Now, this is something which we have already talked about. We were talking about the mean, right? How do we calculate the mean, the risk and return for a portfolio? So, friends, when we have to determine the risk and return of a portfolio, so when I talked about portfolio, I said that, let's say if I am making a portfolio of two securities, only A and B, right? And I am given the mean and the variance of these two securities, right? So with the help of AB, that is with the help of the individual means and individual variances, I can calculate the mean, or you can say, let us put it as returns and risk, right? We can measure the risk and returns of the portfolio too, right? In order to calculate the returns of a portfolio, the simple formula given to me is I will have to use the weights, right? How much money I'm going to put it in A, how much will be the weight of B in my portfolio, right? Let's say it is W1 and W2, 2. Then the formula goes as, if I have to determine the returns of my entire portfolio, I will take into account the weight given of A security. So weight of A into the mean of A plus weight of B into the mean of, right? That is how we try to calculate your portfolio returns. And then we also calculate the risk of portfolio, right? So the risk of portfolio is calculated by using this formula, wherein again I am using the standard deviations, or you can say the variance, and the weights given to me. But here I am also going to use something called as the correlation coefficient between the security A and B. Right. So if given to me is the weight of A security is WA and the weight of B security is WB, then the risk of my portfolio will be written as WA square into your variance of A square plus WB square into variance of B square plus 2 into WA, WB, standard deviation of A, standard deviation of B into your correlation coefficient of A, right? The entire into your square root. You will do a square root of this formula. Friends, this formula is the most simplest formula, the one which we used to use in our 9th standard maths, A plus B, the whole square formula, which is A square plus B square plus 2A. Right? So this is the formula which we are using out here, right? We calculate your risk. Okay. And if, let's say, the portfolio mean with an N investments, if it is given to me as there are N investments, then it will be a summation of all the securities, because here I was taking a portfolio of only 2 securities. But let's say if there is a portfolio of N number of securities, then I am going to take a summation of all the weights into their respective means, right? And the standard deviation will also be with the weights and their respective means, their respective standard deviations and the correlation between the securities, right? So that is how we calculate the risk and return of a portfolio. Before we move ahead, I'll just try to walk you through one important the calculation which I have done it for a data. Friends, this is a data which I have collected for 2 securities. One is Hindustan Unilever and SEBI, SBI, that is State Bank of India. So I have taken some monthly returns. So this is an actual data which I have taken. So I have taken the data of, these are the share prices of Hindustan Unilever, and these are the share prices of State Bank of India, the closing prices on a monthly basis, right? At the month end, I have taken these data. So I have captured these prices. Now, as I had said earlier, now friends, we had already discussed this, that we have to calculate the PR of each security by taking the difference between the 2 securities. So how do we do is the price at month 2 minus your price at month 1 upon your price at the closing of the first month into 100 is what is your HPR, and that is how you can have a look at the formula which I have used over here. What I have done is 865.9 minus 855.4 divided by 855.4 will give me a return of 1.23 monthly return. So this is HPR holding period return. So it is for a month. So a monthly return of Hindustan Unilever is 1.23. Similarly, for State Bank of India also, we use the same formula of HPR, right? The price at the end of second month minus the price at the end of first month divided by the price of the first month. That will give you your HPR. So once we have the HPR, because friends, I have taken a data of 30 months, but definitely the HPR will get it for only 12 months, right? So we have got the data of the 12 months. Now, with the help of the formula, using the function T of average in the Excel, I have tried to calculate the the means of both the securities, that is HUL and HUF, and then variance is calculated using the variance function in my Excel, and standard deviation also can be calculated. Either I can take the directly, I can take the square root of your variance, or I can use the function of standard deviation in my Excel, and I can calculate my standard deviation, right? That is my risk. So this is my returns, and these are my returns or risk of individual securities, that is HUL and SBI. Now I am trying to calculate, I'm trying to create a portfolio of these two securities. So what I need to do is one more important factor that I need to understand, or I need to develop, is the correlation coefficient. As I said earlier, I need to understand what will be the correlation coefficient between these two securities. If I have to have both the securities in my portfolio, what should be their correlation coefficient? And then you, by using the function key of CORREL, right? That is the correlation coefficient function in the Excel. I can determine, and the array that I will be using is the individual returns of HUL and the individual returns of SBI to determine my correlation coefficient. Once I have the correlation coefficient, and as I had shown you the formula for determining the return and risk of a portfolio, and once I know that my portfolio, let's say, is comprising of 50% of my money into HUL and 50% of my money into SBI, this is what I will be getting. That is, the return on my portfolio will come to 3%, wherein I am using 50% as the weights for both the securities. I will take their individual means and multiply them respectively with their weights, right? That will give you your return on your portfolio, right? So this is something which we have already done. So your expected returns, right, of your portfolio, or you can say your mu of your portfolio, will be W1. Say, let's say I use for Hindustan Unilever, I say WH into your standard deviation, sorry, your expected return of H plus W weight of SBI into your expected return of SBI, right? So this too will give you your expected return of the portfolio, that is 3%. Now, if I have to calculate the standard deviation of the portfolio, and as I had given you the formula for the standard deviation of the portfolio, so what we do is WH square into standard deviation of H square, or you can say variance of H square plus W S the whole square into standard deviation of S the whole square plus 2 into WH into WS into standard deviation S, sorry, standard deviation H into standard deviation S into the correlation coefficient of H and S. So that is what I have done it. If you can just have a look at the formula which I have used to calculate the standard deviation, this is the same formula. I have just put in the numbers and the risk which I have got for this particular portfolio, that is comprised of HUL and SBI. The risk is 5.36, right? So this is, so your portfolio returns is 3%, and your standard deviation for your portfolio is somewhere at around 5.4%. So this is what we will get by using these formulas, which I have already showcased it. Now, friends, let us understand a very important concept of what Markowitz has been talking about, your efficient frontier. So this is what I have already talked about. Now let's concentrate on something which is called as your efficient frontier, where I try to calculate your minimum variance portfolio. So how do we do that? Let me walk you through a simple example. Now, friends, as we have already discussed about the risk and returns of individual securities, and then we also talked about the risk and return of portfolios. Let's take into account the returns on my y-axis and the risk on my x-axis, right? So what happens is, now let us understand that Henry Markowitz had come up with a very beautiful concept of portfolio optimization, right? You must have discussed this in brief in your book 4 also. Now, Henry Markowitz said that we are only going to, and uh, in order to achieve an efficient portfolio, or in order to get an efficient portfolio, the two important parameters which I am using is only my mean and my standard deviation, or to put it the way, my returns and my risk. So these are only the two important parameters I am using to develop a efficient portfolio. That is what was the first assumption made by Henry Markowitz. So Henry Markowitz portfolio optimization theory talked about only two important parameters, that is mean and standard deviation. It talked about diversification and it also talked about correlation coefficient. So these are the assumptions of Henry Markowitz portfolio optimization theory, which says that all other factors remaining constant, I am only going to determine my efficient portfolio taking into account the mean and standard deviation, that is the risk and return of my portfolio. Okay, so here I am taking into account the returns of my portfolio, right? And here, let's say we are talking about the risk of my portfolio. So that was the first assumption made in your portfolio optimization theory. Then Markowitz also talked about that with the help of diversification, I will always like to mitigate the risk. So it also talked about the individual's risk averseness, right? When I say risk averseness, that means how tolerant I am towards my risk, or how what is my risk appetite. That is what, and the assumption which was made that by nature, every individual is a risk averse individual. Risk averse means that means he will never like to take more risk. And if he is taking a risk in his portfolio, he will always like to be compensated for the risk. That means he will always expect a risk premium for taking any risk. That is what is other assumption which was made by Henry Markowitz portfolio optimization theory, which said that every investor by nature is a risk averse individual, right? That means he wants some sort of compensation for the risk which he is taking. But depending on the risk appetite of an individual, the averseness will also vary, right? So we are not talking about all that aspects. Let us focus on the efficient frontier. So he also said that given a level of returns, right? Investor, a risk averse investor, will always like to have the minimum risk, right? And given a level of risk, a risk averse individual will always like to have the highest returns, right? So if let's say your risk is known, right? If there is a given level of risk, I will always like my returns to be the highest, right? If let's say I am aware of the returns, or let's say the returns are known to me, then I will always like to have the minimum risk in my portfolio. That was the third assumption which was made in the Henry's portfolio optimization theory. So now I'll be just putting in some numbers. So let's say as he talked about different portfolios, right? Let's say we are talking about a standard deviation of 0, and here we have something called as 6% returns, then 8%, 10%, 12%, and 14% returns, right? So these are some returns which are given to me. And then there are some risk numbers which are known to me, that is 10%, 20%, 30%, 40%. Now let's say this is the information which is known to me. So I am plotting all my returns on the y-axis, and I am plotting all my risks on the x-axis, right? Now, friends, for every every level, I will be having number of portfolios that I can develop, right? So let's say for a 8% return, I have A, B, C, and D portfolio with me, right? And at 10% returns, there are P, Q, R, and S portfolios that are available, right? And then for 12%, we have N, O portfolios. And for, let's say, 14% returns, we have, let's say, X, Y, Z. Now, friends, when there are so many portfolios with different combinations and permutations combinations, I have got so many portfolios with different securities and then seeing their correlation coefficient, taking their individual risk and return. I have developed N of portfolios with me, and these are all the portfolios which are available, and all the portfolios risk and return I have plotted on this graph. Now, friends, if I know, as I said, if the returns are known to me, I will always prefer a portfolio which has the least risk. So in this case, where I have for a return of 8%, I have portfolios A, B, C, and D, and let's say there are many others, E and F. I will among all the portfolios that are available at a return of 8%, or let's say all portfolios which are providing me with returns of 8%, I will always choose the portfolio which is at the least risk level, right? So here, 10% risk, right, is what is the best portfolio, optimum portfolio for me. Why? Because given the level of returns, right, the least risk is at 10%. So it is the least risk is by at level of at portfolio A. Similarly, for let's say for 12% returns, so I have P, Q, R, and S, right? And here for a 12% return, 20%, let's say, is the level minimum variance or minimum risk level which is available. So I will select P. Then for, let's say, here I have 13%. I will include one more. So for here, let's say M is at 13%. M, N, and N, all the three portfolios are giving me the same level of returns, but M is a portfolio which has less of risk, let's say somewhere at around 28%, right? 28% is what is the minimum risk at M. So I will be choosing the security which has the maximum return, but at the minimum risk level, right? So that is how we are going to select these portfolios. So given the risk, I will choose the returns which are maximum, and given the returns, I will choose the portfolio which gives me the minimum risk, right? So that is how Henry Markowitz has defined efficient portfolio or efficient frontier. So when all these portfolios together, right? When I try to draw I join all these portfolios, it is nothing but it is called as your efficient frontier. We call it as your efficient frontier, right? Why? Because at the least risk level, I am getting the maximum return. So these are all the portfolios which lie on this efficient frontier will be, or this particular line will be called as your efficient portfolios, right? So all these portfolios will be your efficient portfolios, right? So now the same thing, if I have to show it to you on your in your Excel. So same thing, if we have already worked on HUL and SBI, right? We found out their respective risk returns, there we found out the portfolio of 50% in either of in the two, and then we developed their risk and return, and then we also calculated their correlation coefficient. And then now, if you can see, this is how I have tried to create n number of portfolios wherein starting from putting 100 rupees in SBI, to all my 100 rupees in HUL. So what I'm doing is I'm changing the weight of my investments in either of the two securities, and I'm trying to figure out which can be the best portfolios for me. And as I have already shown it to you, the portfolios which are least risk, yeah, which we can say which has the least risk, right? But give me the good return, right? That is what is the preferred portfolio, right? So here I have tried, a lot of permutations. I have changed the weight of HUL and SPI, and I have tried to get these numbers. So these are my returns, and these are my risks of each portfolio, right? A portfolio with 100% in SBI and 0% in HUL. HUL will give me 1.92% returns in the portfolio, and 8.8 will be the standard deviation. And when I use all these numbers, right? These numbers, when they are actually plotted on a graph, this is how I will get my this is how the portfolio, this is how the graph will look, right? So this is my graph. Now, friends, this is not a uh, very close way of understanding. So I have modified my data a little bit to have a better picture of my efficient frontier. So you can see that, if I change a few numbers here and there, uh, so I get this is my efficient frontier, right? Now, friends, efficient frontier. This is my efficient frontier. But you can see that there is a security. Let's say this is a security where let's say 3.69%, right? 3.69% is my portfolio standard deviation, and 3.98. So this is what we are talking about. Right. So we have to see that, or we can take the least risk, right? So this is the least risk. Let me see what is the number coming. So over here, the number is, so it is 3.51 and 3.87. That means 3.51 is my standard deviation and 3.87. So you have to check out which is the least. So 3.51 is the least risk, right? So 3.51 is over here. So this particular portfolio, or you can say this is the on the efficient frontier. So this is the minimum variance frontier. It is called the minimum variance frontier, where which all the portfolios with the least risk, as I had shown you earlier in the diagram. So the least risk or the minimum variance frontier is what has been drawn, and you can see this is the sorry global minimum variance, right? It's at a level of 3.1%. Uh, so it will be at this particular portfolio, right? So portfolio with 60-40% in HUL and SBI respectively will is the point, or this is the portfolio which will have the minimum variance, the global minimum variance. So out of the minimum variance frontier, this is the minimum variance, but it will be something which will be at a lesser of returns also. The returns will also be low. So friends, if you have check on these two portfolios, right? Let's say these two are the portfolios. You can see that if I draw this way, right? So there is a portfolio over here. There is a portfolio over here, both in the efficient frontier. So let me name it as, once again, let me change the color. So let me have a portfolio A and a portfolio B. Portfolio A, right? So portfolio A and portfolio B, both have a standard deviation of 4%. But in portfolio A, I am getting a return of 4%, somewhere close to 4%. And in case of B, I am getting a return of, let's say, somewhere at around 3.75%. So what will be your say in this, that when the variance is the same in both the cases, why should I go for a lesser of returns when taking into account the same level of risk, I can earn a better return. So what will happen is you will reject this portfolio. Similarly, when there are two portfolios at this level, or let's say there are two portfolios available at this level, you will always like to reject those portfolios which are giving you for the same level of risk, which is giving you less, which is giving you a lower return, right? So what we do is generally in when we talk about a global variance, so the way I have done it over here, you can see this one, that now let's say this is my efficient frontier, right? So, and sorry, again, right? So let's say this is my efficient frontier. It has to be a little concave. I don't know, it's not coming up that good, right? So let's say this is my efficient frontier. Okay, and as I said that there are different portfolios on the efficient frontier, right? This is your global minimum variance, right? And it is a concave like this. So if there are two portfolios which are having the same level of returns, but in one case the risk is high and the other case, sorry, the risk is at the same levels, but the return in one case is low and the other case is high, I will always reject the ones wherein the returns are low. So what will happen is your efficient frontier will now look something like this, right? So it will start from your global minimum variance, and all the upper ones will be the ones will be called as will be on your efficient frontier, right? So that is how we determine your global minimum variance and your efficient frontier. That is how you can see it on the slide now. Here the essence is that there is a large number of portfolios available for investment, but we must choose a single optimal portfolio. So there are different portfolios on the sufficient frontier, and if there is A and there is a portfolio C, which is giving you which is at the same level of risk, but are giving different levels of returns, we'll always prefer A, right? So this is the minimum variance frontier, and this point is called as the global minimum variance portfolio, right? So this is what I have already shown it to you through an Excel and through the chart. So what is minimum variance? It is one that lies on a solid curve, and the collection of all the portfolios is known as the minimum variance frontier. Your global minimum variance is the least amount of risk, right? The leftmost point on the minimum variance frontier is the global minimum variance portfolio. What is an efficient frontier? In the efficient frontier graph, out of all the choices, an investor will choose a portfolio A over portfolio C. That is what I have shown you, that in case of A and C, right, both are having the same risk exposure, right? So A is also having this standard deviation, C is also having, and both are on the efficient frontier. But in A, I am getting a higher return, so the returns on A is higher than returns on C. So my choice will be always A rather than C. That is what is your efficient frontier of the curve. So the curve that lies above and to the right of the global minimum variance portfolio is referred to as the Markowitz efficient frontier. That is what I was talking to you about. That means Markowitz said that As a risk-averse investor, I will always like to have the minimum risk and the maximum return on my portfolio, right? Because it includes all the portfolios of risky assets that rational, risk-averse investors will choose compared to the rest of the portfolios. I hope this is all clear to you all, friends. So, efficient port frontier says that if I can draw number of portfolios, taking into account a lot of permutations and combinations of rates and also asset classes, I will get n number of portfolios for a given level of risk and return. Right? But I will always choose the ones which give me the maximum return for a level of risk and the minimum risk at for a given level of return. Right? So that is what is an efficient frontier all about. And then there is something called as your capital allocation line, right? So capital allocation line is nothing but when you can say that this is my efficient frontier, right? So we have already drawn your efficient frontier. Now, friends, as I said earlier, there is something wherein with the standard deviation of zero, I am going to earn a risk-free rate of interest, right? So RF is your risk-free rate of interest. That means without taking any risk, when I'm able to generate some returns, it is called as risk returns. The point line which joins tangential to the efficient frontier. I'm so sorry. One second, I'll do it again. So if I am drawing a line from starting from risk-free rate to your, joining tangential to your, so this is your efficient frontier, concave, right? So this is your efficient frontier. The point that joins your this is called as your capital allocation line. The line starting from your risk-free rate and tangential is tangential to your efficient frontier, and then where the portfolio where it joins, it intersects with your efficient frontier is called as your optimal portfolio, right? This is called as your optimal portfolio. It is also called as a market portfolio, right? So it is also called as your market portfolio. Right? So this is very, very important, and this has been explained by Markowitz portfolio optimization theory, which says that if I have n number of portfolios available with me, I will always like to have those portfolios. So in order to have an efficient frontier, I would always like to have those portfolios, or I would like to choose those portfolios where the risk level is low and I get the maximum returns, right? And when I join all those portfolios and I get a concave, that is my efficient frontier. And I will talking first this efficient frontier or intersect the frontier, right, tangentially, which runs through your efficient frontier is called as the capital allocation line, and the point where it joins, intersects your efficient frontier is called as your market portfolio. I hope this is clear to you all. So this is what we have already talked about, that in the above graph, two combinations between the risk-free and the risky assets are there on your cal, right? And the portfolios on cal P that dominate the portfolio on cal A. So there are two cals which I have drawn. One is which is running both are running from your risk-free rate. One is on the P and one is A. So when the one which is running is intersecting the efficient frontier is called as to be the efficient portfolio, right? So by combining the efficient frontier and the CalP, we can conclude that the point where both intersect is the best achievable and optimal portfolio, right? That is the portfolio point. In this case, this portfolio where the intersection is happening is the optimal portfolio, and it is also referred to as your what do you call it as market portfolio. So mean variance framework, it has some limitations. Why? Because we discussed, we in the beginning itself, when we started with talking about market portfolio optimization theory, we had certain assumptions, right? And these assumptions may not always hold true, right, in for different asset classes or for in different market scenarios, right? And that is the reason they have certain limitations. What are the limitations? Mean standard deviation correlation between different investment returns is consistent, right? That is what is the limitation. Mean and standard deviation really matters for the portfolio. So here we are saying that we are going in with a mean, that is your risk, return, and correlation. These are the only the three parameters which are taken into account. They are consistent. They are the same all the time. And on that basis, I'm developing my shift right. One can borrow this free rate, right? So when we talk about a cal, right? So till here, I will be using my money, but when it goes above your market portfolio, it will be through the money borrow. I will be borrowing the money to invest in these portfolios, right? So here that is what it is saying, that one can borrow at a risk-free rate, which is not always possible. Standard deviation is not the right measure of risk for non-normal distribution, right? So something which is non-symmetrical, definitely your standard deviation will not work well, or it will not give you the right picture if you go in for a non-normal distribution. In real world, financial assets may have fatter tails and skew, which defies the assumption of normal distribution. So we say that the normal distribution, but there are quite some chances that it can be positively right skewed, or it can be left skewed, right? And they can have fatter tails, right? So the tails can be fatter. Here, if the scenario, the market scenario, if there is a stress period going on, if there are any crises, so then these things will not give you the clear picture, right? And then we need something which is more stringent, right? Which can give us a better picture about the risk and return of my portfolios, and that is where we take into account something called as value at risk. So value at risk is again a measure, is a tool to measure your risk in a portfolio, right? To measure the risk, it is a risk parameter. So value at risk is what it has become a standard measure that final financial analysts use to quantify the risk. So if I have to measure the risk, if I quantify the risk, I always went for uh, for a value at risk. Now, what is value at risk, friends? Value at risk represents the maximum potential loss in the value of your portfolio of a financial instrument with the given probability over a certain time horizon. So if I am talking about a 1 day time horizon, or let's say a weekly time horizon, or a monthly time horizon, or a weekly time horizon, I will take a time horizon and see that what will be the maximum potential loss which my financial instrument or my portfolio will will have, right? In simpler words, indicates how much a financial institution can lose with a given probability over a given time horizon. So here I am taking into account two important aspects. What is the probability of losing the money, right? What is the probability, and what is the time period, right? So these are the important parameters which are taken into account to calculate your value at risk. Now here, let's say 95% daily VAR of your assets is $120, then what will it mean that out of the 100 days, right? Let's say my time horizon is of 100 days, there would be 95 days out of the 100. Yes, since I am talking with a level of confidence at 95%, right? So I will say that out of 100 days, 95 days, my losses will be less than 120. That means there are only 5 days when the losses may go above $120. That is how we understand war. So value at risk is what it is talking about. The time horizon, it is talking about the probability. So the level of confidence, right? So the confidence level will determine that how much I am going to lose, what will be the maximum loss which I can make on a single day, right? This implies that during 5 days, you may lose more than 120 daily, right? So on a daily basis, if I need to understand what will be the maximum loss I can make, what is the best to measure the risk? There may be a day out of 100 when your losses is $5,000, which means your one does not tell anything about the extent to which we can lose. It will just give you a threshold limit. So if let's say I have to calculate my VAR, this is my mean, right? And here, if we are talking about 95% confidence interval, so 95%, right? With the level of confidence is, let's say, 95%. So I will say only 5% chances that it may go above the threshold limit of $120, right? But how much it will go? The quantum is not known, right? So quantum is not known to me in case of my VAR, right? So it will not talk to you about the extent. It can only talk to you about that threshold limit up to which you will come to know that on a daily basis, my loss will not exceed this levels, right? Given a level of confidence. So if we have to visualize a VAR, so I'm talking about a 95% daily VAR, right? So this is with this 1.28 is your level of confidence. So your Z score at 95%, 90% level of confidence is 1.28. Your Z score for 95% confidence level is 1.65, and for 97.5 is 1.96, and 99% is just 0.3, right? So this is something which we have to always remember, because there will be stuff which will be coming to you on where these levels, the Z score will be not given to you. They will only mention to you about the confidence level, right? So given the confidence level, I should know what will be the Z score pertaining to that level of confidence, right? So the colored area of the normal curve constitutes 5%. So this is the 5% area, friends, right? So it will say that on a daily basis, if 95%, this is the 95% area. So this is the 95% area, which is called as the level of confidence. Okay, friends. So this is your level of confidence, and this is your alpha, which is your level of significance. Right? So I can say that with 95% times or 95% confident that on a single day, my risk or my losses will not exceed more than this level, right? But what will be the extent that I may not be aware, right? That will not be defined to me by my VAR. So VAR will only give you your threshold limit. It will only give you your threshold limit. It will not tell you about to what extent your losses can be, right? So I say that yes, 120, it cannot go beyond 120. It will be only 5% chances that it will go, but up to what level it will go, it is not known. Right? So the 5% probability that losses will lie in the colored area is more than the VAR. So how do we measure the VAR? The formula, if I have to calculate my VAR for X%, that is given a level of confidence to me in percentage, I will take the Z score at that uh, confidence level. That is what it is written over here. I will multiply it with your standard deviation, right? And this will give you your VAR in percentage. And if I have to calculate it in absolute terms, I will multiply it with your value exposure. Right? So whatever is your exposure, I will multiply it with that. That will give you your VAR number in absolute terms, right? So measuring VAR, how do we measure VAR? So if the normal distribution value for the given probability, that is X%, Normal distribution has a mean of 0 and a standard deviation as 1. This is something which we always have to remember, friends. If we are talking about a normal distribution, we need to understand that your mu will always be 0 and your standard deviation will always be right. So this is the primary assumption of your value at risk. Standard deviation, that is volatility of the asset or the portfolio. That is your standard. This is what is your standard deviation. What in absolute terms, that is what I have already said. Once I have a known of your VAR in percentage form, I have to multiply it with your asset, right? This can be written as Z score at a given level of X percentage into standard deviation into asset value. This is something which we always have to remember, friends. I will be walking you through some examples so that you are clear as to how to determine your VAR, right? So measuring value at risk. Um, so this is on a, if I have to calculate it on a daily basis, given the n number of years. So if let's say for n days, I have to calculate the VAR. So given a daily VAR, let's say daily VAR is given known to me, and I have to calculate it for n days, right? So I'm going from 1 to n, so I will multiply, right? If I am given a VAR of n days and I have to calculate for a daily, for a 1 day VAR, then I will be dividing it. So what I'm going to multiply? I'm going to multiply with the root of n. Here I'm going to divide it with root of n. This is something which we have to remember, friends. So daily volatility or n number of days of volatility, if I have to calculate for a given number of days, if it is from one daily VAR given to me and I have calculated for n number of days, then I am going to multiply it, right, with the daily VAR. So this is my daily VAR at a certain percentage level, at a level of confidence. I am going to multiply it with the square root of the number of days. But if it is the other way around, then I have to divide it. So if it is a daily, I have to know the daily VAR given, let's say, a yearly VAR or 250 days VAR is known to me, and I have to calculate it for 1 days, then whatever is the VAR for 250 days, I am going to divide it with square root of 250 of n. So your n is 250. So that will give you your VAR for, will give you your VAR. It will give you your VAR for T1 day, right? So our T VAR can be calculated using this formula. So if I have to take this example, here what we're talking is, we're talking about a 99%. That means there is only 1% chances that your VAR or the losses will exceed. The VAR says that there are chances that it will exceed your VAR. So it will be, there are only 1% chances that the losses may exceed your VAR number. Right? So I need to understand what is your Z score at 99%. So if you have to understand, I had told it to you earlier also, friends. So here you have to take this number, right? So 99% is talking about 2.32. So how do we calculate it? What is known to me? So the Z score is 2.32, right? Standard deviation given to you is 1.6%. Your asset value is at 10 million USD, right? So how will I calculate my VAR at 99% confidence, right? It will be whatever is the Z score at 99% level of confidence into your standard deviation into your asset value, right? So that is how much? 2.3 into 1.6 into your 10 million, right? So that is how you calculate your VAR. So the solution you can see it is 1.6 percent. I have written it in percentage format, right? So you can see over here. So this is my standard deviation. This is my asset value. And this is my Z score at 99% confidence, right? So when I multiply all these three numbers, I will get a daily VAR of 0.3728 million. That means million USD. So this is what on the daily, that with 99% confidence, I can say that for a day, my losses cannot exceed above 0.3728 million. Right? Is it clear? So what is the VAR value of a 10-day VAR in the earlier case? So friends, as I said earlier, I have a daily VAR, right? A daily VAR of is known to me. What is that amount? It is 0.3720. So 0.3728 million USD is what is your VAR. Now they are asking you to calculate your 10-day VAR. So how, as I said earlier, from 1 day to you are going to 10 days. So you're going to multiply it. So whatever is your daily VAR, that is 0.3728 million USD into the square root of the number of days and given to me as 10 will give me 10-day VAR. So this is how I will calculate. So 10-day VAR will be 1.1789. I hope this is clear to you all, friends. So that is how we try to find out the 10-day by multiplying it with your daily VAR. So here another example I have taken. Here the daily portfolio VAR at 7.5% is what I need to calculate. Right, so your confidence interval is given to me as 97.5%. Right, so confidence interval is 97.5. Investment in asset A. So asset A, I am doing an investment of $40 million. And investment in asset B is $60 million. Okay. The volatility of asset A is 5.5%. Volatility means nothing but your standard deviation. And volatility of B is 4.5%. Right? So the portfolio VAR of correlation between, now let's say A and B is a correlation coefficient of A and B is 20%. Right? So friends, the way we had found out the standard deviation of a portfolio, right? The same way we can find out the daily VAR given the VAR. Sorry, this is not given the volatility. I can determine your VAR of A and VAR of B, and then the portfolio can be done with the help of the same formula, wherein W1 into VAR. Here I will be taking VAR1 the whole square plus W2 into VAR2 the whole square plus 2 into W1 into W2 into VAR1 into VAR2 into your correlation coefficient of VAR2. So this is how we calculate the VAR of your portfolio. Friends, the same formula which we were using for calculating your standard deviation of the portfolio. Right here, the only difference is I'm not going to use it by square root. Right, I'm going to take it as the total VAR of portfolios of A and B. So for calculating the VAR of the portfolio, I need to calculate the VAR of A security. In my case, it's A, and I need to calculate the VAR of B at a 90. I think it was 97.5% confidence level, right? So how do we calculate for VAR A? What will be the formula? As I said, the Z score at your 97.5% into your standard deviation of A, right? Is what is going to give you the VAR for A in percentage and VAR of B in percentage terms. That is what I need. I don't need it for the value, right? So I'm sorry, here also we'll take the standard. It is like standard deviation only. Why? Because we are calculating the risk of the portfolio. So your Z score into standard deviation of A will give you your VAR of A, and the Z score at 97.5% into your standard deviation of B will give you your VAR of B. So by doing this, I know the VAR or standard deviation is 5.5, at the 97.5%, the Z score comes to 1.96. I multiply this two. So standard deviation of B is 4.5. So I get the individual bar of A is 10.78, sorry, 10.78%, and the bar of B is your 8.33%. So when I use these numbers and calculate my portfolio VAR, the bar that comes to me is 7.22 million. Right. So here what I'm doing is I'm multiplying it again with these are the weights, 40 and 60 are the weights. Right. This is the correlation coefficient. Once I get the VAR in percentage terms, I will multiply it with the notional value. So here they are saying it is 40 million in asset A and 60 million in asset B. So you will get the number as 7.22 million is the VAR of your portfolio comprising of A and B. I hope this is clear to you, friends. Just give me a minute. I'll take a break of 1 minute before we resume. So let's move ahead and understand. So this is another example where we have to calculate the 90, at a 95% confidence with 95%. I need to put 250 trading days in a year. The market value of our asset is 10 millions and the daily variance is 0.05. So when it is 95%, as we had already seen, it is 1.65 is what is our Z score. So I will calculate it. 10 million is my asset value. So daily VAR, firstly I have to calculate your daily VAR. This is something which I've already talked about. So it is just for understanding it in a better way, and so that we never forget it. I am doing more and more practice sums so that you people are clear with the concepts, and there's no way in which there is any errors done by during the examination, right? So what I am doing over here is, friends, I am calculating the VAR. Right, so daily VAR first I calculated by using the same formula, that is whatever is the Z score at 95% confidence interval, then whatever is your standard deviation and multiplied with your asset value, right? So your Z score for 95% confidence interval is at 1.65, and then your standard deviation given to you is 0.005, right? So they had given you a variance. So if you can see, they have given you a variance. So if I have to calculate the standard deviation, I have to take a square root of your variance, right? This is something which we have to be very, very careful. When you're writing your examination, please read the question properly, because what may happen that you may consider this as to be your standard deviation and everything will go topsy-turvy. So it is always better that you firstly read the question carefully, understand the question well, and then start solution, because the solution is not that tough, right? So you can just give me a minute. Right, so what we have done is over here, so 1.65 is your Z score, and then standard deviation is the square root of the variance into your asset value, right? That is 10 million USD. So you get a number, a daily VAR of 0.36895 millions, right? That is what you get as your daily VAR. Once I have the daily VAR, as I said earlier, I can calculate it an annual VAR, and assuming that there are 250 trading days in a year, I will calculate the annual VAR as the daily VAR, whatever is your daily VAR which you have computed using that formula. I will multiply it with the square root of your n, that is your 250 days. So 0.36895 million is your daily VAR, into square root of 250 days will give you a VAR of 5.83. That means with 5%, there are only 5% chances that during the year your losses will exceed 5.834%. That means with 95% confidence, you can say that there is the losses may exceed 5.834 million in a year, given on a daily basis, right? So, for an uncorrelated portfolio, what is the VAR? If the VAR asset is 10 million and the VAR asset B is 20 million, friends, if they are uncorrelated, the VAR will come out to be, what will be the VAR? It will be nothing but it will be the whatever is the weightage given to both of them. I'm using those weights, and that will give me a VAR of 22.36 million. Now, let us talk about some important properties of a coherent risk measure. Right now, friends, what do you mean by coherent risk? Coherent risk is, as we said, inherent risk is what we have already talked about. Inherent risk is something which we try to inherent, which is already there in the system. Coherent risk is something which we try to measure with the help of your inherent risk. Given your inherent risk, whatever is already there in the system, taking into account all the economic factors, or whatever factors are going to influence the market prices, I am going to determine the risk that is called as coherent risk. So there are different properties of coherent risk. One is monotonicity. That means a portfolio with higher future returns will be likely to have less of risk, right? So with if what is the first property of coherent risk, which is talking about monotonicity. Monotonicity means monotonous. That means if a portfolio has a higher return, right, higher future returns, will be likely have a less of risk. That means if the returns are if the returns of one portfolio is greater than or equal to returns of second portfolio, the risk of one portfolio will be less than the risk of two portfolio. As we all are aware of this, higher the risk, higher will be the returns, right? So the higher future returns will be likely to have less of risk. Sub-additivity, what it says is that this is something which we had already discussed. The risk of a portfolio is at most equal to the risk of the assets within the portfolio. So if they are uncorrelated assets, right? If there is no correlation that prevails in the assets, right? Then if there is the risk of portfolio of A and the portfolio of of asset A and asset B, if I have a portfolio of both the securities, it will be nothing but a summation of the individual risk of A and B, right? Positive homogeneity, what it says is the size of the risk will impact the size of its risk, right? The size of the risk will impact the size of its risk. That means if the risk of one, that is whatever is the risk, positive homogeneity will say that whatever is X is, let's say, the risk. So it will be, if I have to, that will be that will be the size of its risk. That means it will be added that many times, right? So translation of invariance is the risk of a portfolio is dependent on the assets within the portfolio, right? So if there is any cash there in your portfolio, so your total risk will be less of that cash. Why? Because there is no risk for holding the cash. So this is something risk free. So out of my total risk, as we have already discussed, your total risk talks about two risks, that is systematic and unsystematic risk. So this risk can definitely be mitigated through diversification. So that if, let's say, there is I have two securities in my portfolio, wherein one is with some risk and one is with risk free, then my total risk will be only comprising of the risk of that particular asset class and not the one which has risk free, right, friends? Now coming to expected shortfall. Now, friends, we in our previous discussion we talked about VAR, value at risk, right? So the value at risk is only giving me a threshold level, right? It is only talking about the level beyond which the losses will not exceed on a daily basis. So this is, let's say, at a 95% level of confidence, right? If I'm saying this, this is my, let's say 95% VAR, right? So it is only giving me this level at which it will not exceed. But what will be the extent, the quantum of losses is not defined by your VAR, right? So what happens is VAR, friends, generally what happens is every financial organization, they will determine their VAR in order to calculate the risk in their portfolio. They will calculate the VAR, right? Because many a times the banks, the financial institutions, they become complacent. Why? Because VAR is just giving them a threshold limit, and taking into account the level of VAR, they can always have some sort of provisioning done on that basis, right? But it is not giving you a true picture. Why? Because it is only talking about the threshold level. It is not talking about the extent to which the losses may go, right? Beyond your VAR level. That is what is missing in case of the VAR determination. There, we the expected shortfall is the best method, or you can say is the best way of quantifying your risk, or in determining your risk levels, so that your provisioning can be done accordingly, right? It is expected loss below the pre-specified worst case return. So whatever is your worst case return, that is your whatever is your threshold level. Beyond that, whatever is the loss, it is a pre-specified worst case return is called as your expected shortfall. So whatever is at this level, right, that becomes your expected shortfall. Okay, friends? It is also known as a conditional VAR or expected tail loss. That means, given a loss at a VAR level, right? If the loss given, so if it is conditional, that means what will be the loss given the VAR level, or the maximum loss at a VAR level. So that is the conditional VAR. And here we are trying to find out what is the losses at the tail, right? So these are your tails. So when I have to calculate my losses at the tail, I call it as my expected shortfall. And one thing which we have always remember, friends, that your expected shortfall will be greater than your VAR. Okay. For a normal distribution, if because what we are assuming in case of VAR also is that my returns are normally distributed. Okay. So if I am continuing with the same assumption of normal distribution, the expected shortfall can be calculated by using this formula, right? So it is how large a loss is expected in case of an extreme scenario, right? If there is any stressed scenario that exists, like the way we had it during your financial crisis of 2008, right? During such a scenario, your VAR may not give you a clear picture. It may not give you the clear quantum of risk, right? It will not be the right risk measure. In such a stress period, in such extreme scenarios, it is always better that we go for an expected shortfall, right, friends? So just give me a minute, please. So expected shortfall will be a more better determinant compared to VAR, right? Why? Because it is always a higher number than a VAR, and more, accurate measure of understanding during extreme scenarios. And your expected shortfall is a coherent risk measure. It satisfies all the four assumptions. So all the four assumptions of monotonicity, subadditivity, positive homogeneity, and translation invariance, all these coherent risk measures properties can be are taken care in your expected shortfall, right? VAR does not satisfy subadditivity, right? So VAR is something which doesn't fulfill this particular measure, right? Sectoral risk measures that assigns weights to the percentiles of the loss distribution, that is your risk measure. A general risk measure, then VAR or expected shortfall, is called as your risk spectrum, right? The VAR, that is the X percentile of the loss distribution, only the VAR is the given weight. Expected shortfall is probability based weight to all the loss levels greater than your VAR. So weighing function will be 1 upon 1 minus confidence level. That is your level of significance, right? For a tail losses. All losses above bar are given equal weights. All other quantiles have weights equal to 0. This is something which we have to always remember while calculating your expected shortfall. So the VAR and the expected shortfall are inadequate as the weighing function is not consistent with the risk aversion, right? So here, whenever I'm using the weights, when I assign weights to my to the percentiles of loss distribution, since they are not consistent, they will not give you they will give you an inadequate number. So that's all for the first session. Let us now move to the next session, where we'll understand which are the different ways to in which I can calculate my VAR.